It's April 14th. You're sitting at your kitchen table with a stack of receipts, your W-2, and TurboTax open on your laptop. You've been working on your taxes for 3 hours, and the number at the bottom keeps getting worse. You owe $3,200, or maybe you're getting a refund of $800, but either way, you paid somewhere between 22% and 30% of your income in taxes last year. Meanwhile, you read headlines about billionaires paying single-digit tax rates, some paying nothing at all. And you're sitting there thinking, how is this even legal? What am I missing? Here's what kills me. You're not missing some secret loophole that only billionaires know about. You're missing an entirely different game that wealthy people are playing with their money, and I'm going to show you exactly what that game is. By the end of this video, you'll understand the specific legal strategies that keep more money in your pocket and how you can start using them regardless of your current income level. My name is Max, and I want to help you learn how to make your money work more for you in your life. Today, I'm breaking down the actual tax strategies wealthy people use that your accountant probably isn't telling you about, and more importantly, which ones you can implement starting this year to legally reduce your tax burden. So, let's get started, and please make sure to hit the subscribe button and give this video a thumbs up if you like it. Okay, let's talk about what's happening when you pay taxes as a W-2 employee, because this is where most people are getting destroyed financially without even realizing it. When you work a regular job, your employer withholds taxes from every single paycheck before you ever see the money. Federal income tax, Social Security, Medicare, state tax if applicable. It's automatic. The IRS gets paid first and you get what's left. Here's the thing. This system was designed in 1943 during World War II as a temporary measure to fund the war effort. 80 plus years later, it's still here. And it's the single most effective wealth extraction system ever created. Why? Because you never see the money. It's gone before you can miss it. According to the IRS's own data, W-2 employees pay approximately 93% of all income taxes collected, even though they represent only about 60% of total income in the United States. Let that sink in. The majority of tax revenue comes from people who have the least control over how they're taxed. Now, you might be thinking, well, Max, rich people have high incomes, so of course they pay more in taxes. And that's exactly what the system wants you to think. But here's what most people don't realize. Wealthy people don't have high incomes. They have high wealth, and those two things are taxed completely differently. ProPublica analyzed IRS records of the 25 richest Americans and found that between 2014 and 2018, they paid an average true tax rate of just 3.4% when you measure their taxes against the growth of their wealth. Warren Buffett paid 0.10% in 2018. Jeff Bezos paid 0.98% in 2011. These aren't illegal tax dodges. This is the system working exactly as it's designed for people who understand how to use it. So what's the fundamental difference between how you're taxed and how wealthy people are taxed? It comes down to this. You're taxed on income. They're taxed on income too, but they've structured their lives to have as little taxable income as possible. Let me explain what I mean. When you work a job, you trade time for money. You work 40 hours, you get paid for 40 hours, and that payment is classified as ordinary income. Ordinary income is taxed at the highest rates, up to 37% federally, plus state taxes, plus FICA taxes. You could be paying 45 to 50% total in some states. Wealthy people, on the other hand, generate money through capital gains, business ownership, and tax-advantaged investments. Capital gains, profit from selling investments held longer than a year, are taxed at a maximum of 20% federally. That's nearly half the rate of ordinary income. But here's where it gets even more interesting. They often don't sell their assets at all. They borrow against them. And here's the key. Loans aren't taxable. Let's say you own $10 million in Amazon stock that's gone up in value. If you sell it, you pay capital gains tax on the profit. But if you go to a bank and say, give me a $3 million loan using my stock as collateral, the bank will do it at maybe 3 to 4% interest, You now have $3 million in cash to spend, and you haven't triggered a single dollar in taxes. That loan isn't income, it's debt. And when your assets grow faster than your loan interest rate, you're coming out ahead while paying zero taxes on that transaction. This is called the buy, borrow, die strategy, and it's how billionaires live lavish lifestyles while reporting minimal taxable income. Look, here's something your CPA probably won't tell you. There are essentially 3 tax systems in America, and which one you're in determines everything. System 1, W-2 employees. This is where most Americans are. You earn a paycheck, taxes are withheld automatically, and you have almost no control. Your effective tax rate is usually 25 to 35% when you add up federal, state, and payroll taxes. You get a few deductions: mortgage interest, charitable contributions if you itemize, retirement contributions, but that's about it. System 2, business owners. This is where things start to change dramatically. According to the IRS, there are literally thousands of legitimate business deductions available. Your home office, your vehicle, business meals, travel, equipment, education, health insurance, retirement contributions that are significantly higher than W-2 limits. The tax code is written to incentivize business ownership because businesses create jobs and economic growth. System 3, investors. This is the holy grail. Your money comes from capital gains, dividends, and asset appreciation. Lower tax rates, more control over when you recognize income, ability to offset gains with losses, and strategies like 1031 exchanges that let you defer taxes indefinitely. Here's what's crucial to understand. You can move between these systems. You're not stuck in System 1 forever, and you don't need to be a millionaire to start using System 2 and System 3 strategies. All right, let's get into the specific strategies. I'm going to give you the ones that actually matter and that you can realistically implement. Strategy 1, retirement account maximization. This is the most accessible strategy, and most people still aren't doing it correctly. If your employer offers a 401k match, you need to contribute at least enough to get the full match. That's literally free money, and you're reducing your taxable income at the same time. But here's where it gets really interesting. The 2025 401k contribution limit is $23,500. If you're over 50, it's $31,000. Most people contribute maybe 3 to 6%. If you make $80,000 and you max out your 401k, you've just reduced your taxable income by $23,500. At a 24% tax bracket, that's $5,640 in tax savings in a single year. Additionally, you can contribute to a Roth IRA if your income qualifies, $7,000 per year, or $8,000 if you're over 50. This money grows tax-free forever. When you retire and withdraw it, you pay zero taxes on potentially hundreds of thousands of dollars in growth. Let me give you the math. $7,000 per year in a Roth IRA, invested for 30 years at an 8% average return, becomes $765,000. You contributed $210,000. The $555,000 in growth is completely tax-free. If that same money was in a regular taxable account, you'd owe potentially $111,000 in taxes on that growth at a 20% capital gains rate. You just saved $111,000 in taxes by using the right account type. Strategy 2, health savings accounts, HSA. This is what I call the triple tax advantage account, and almost nobody is using it correctly. If you have a high deductible health plan, you can contribute to an HSA. For 2025, the limit is $4,300 for individuals, $8,550 for families. Here's why this is so powerful. Your contributions are tax deductible, the money grows tax-free, and withdrawals for qualified medical expenses are tax-free. No other account in the tax code gives you all three benefits. But here's the strategy wealthy people use. Don't touch your HSA. Pay for medical expenses out of pocket and let your HSA grow. Why? Because after age 65, you can withdraw from your HSA for any reason and only pay ordinary income tax, exactly like a traditional IRA. But if you use it for medical expenses in retirement, it's still completely tax-free. The average couple retiring at 65 will spend approximately $315,000 on healthcare throughout retirement, according to Fidelity. If you have that money sitting in an HSA, you're withdrawing it tax-free instead of paying 20 to 30% taxes on withdrawals from your 401k. Strategy 3, real estate investment. Here's where the wealthy really start to separate from everyone else. Real estate has tax advantages that almost no other investment class has. First, there's depreciation. The IRS lets you deduct the declining value of your rental property over 27.5 years, even though in reality, real estate typically appreciates. Let's say you buy a $300,000 rental property where $250,000 is the building value. You can deduct $9,090 per year in depreciation, even if your property is going up in value. This means you can have positive cash flow from rent, but show a loss on your taxes. That loss can offset your other income, reducing your total tax burden. Second, when you sell a rental property, you can use something called a 1031 exchange to defer all capital gains taxes by rolling the proceeds into another investment property. Wealthy people do this repeatedly, building larger and larger portfolios without ever paying capital gains taxes. When they die, their heirs get a step up in basis, meaning the capital gains disappear entirely. This is the buy, borrow, die strategy in action. Strategy 4, starting a business, even a side business. Okay, this is the big one, and it's accessible to almost everyone watching this video. You don't need to quit your job. You don't need to build a multi-million-dollar company. You just need a legitimate business, even a small one. According to the IRS, there are over 300 different business deductions available. Let's say you start a consulting business, a freelance service, an online business, or even a content creation business. Suddenly, you can deduct home office expenses, a portion of your rent/mortgage, utilities, internet, your vehicle expenses if you use it for business, business meals, 50% deductible, equipment and software, education and training related to your business, health insurance premiums if you're self-employed, retirement contributions up to $69,000 per year through a solo 401k. Let me show you the math on this. Let's say you have a W-2 job earning $75,000 and you start a side business that generates $20,000 in revenue. You have legitimate business expenses of $8,000. Your taxable income from the business is only $12,000, but you've also reduced your tax burden by deducting those $8,000 in expenses that you might have spent anyway, like your internet, your phone, a portion of your rent. At a 24% tax bracket, you just saved $1,920 in taxes on expenses you were already paying for. And that's a simple example. As your business grows, these deductions scale dramatically. Now let's talk about why most people don't use these strategies, because this is just as important as knowing the strategies exist. First, there's a psychological concept called status quo bias. People prefer things to stay the same, even when change would benefit them. You're used to being a W-2 employee. You're used to getting your refund or paying your bill every April. Taking action to change your tax situation feels risky and uncomfortable, so you don't do it. Second, there's the belief that tax strategies are for rich people. This is fundamentally wrong, but it's deeply ingrained. The truth is, wealthy people started using these strategies before they were wealthy. That's part of how they became wealthy. They kept more of their money, invested it, and let it compound. Third, there's complexity aversion. The tax code is intentionally complex. It's over 70,000 pages. Most people look at that and think, I can't possibly understand this. So they give up before they start. But here's what most people don't realize. You don't need to understand all 70,000 pages. You need to understand the 10 to 15 strategies that apply to your situation. Additionally, there's something called present bias, the tendency to prioritize immediate comfort over future benefit. Setting up an HSA, maxing out your 401k, starting a side business. These require effort now for benefits later. Most people choose the path of least resistance, which is doing nothing. You are probably wondering, okay, Max, this all sounds great, but what do I actually do? Let me give you a step-by-step roadmap. Step 1, maximize your retirement accounts this year. Go to your HR department this week and increase your 401k contribution percentage. If you can't max it out immediately, increase it by 1 to 2% every few months. Set a goal to reach the maximum contribution within 2 years. If you don't have access to a 401k, open a traditional IRA or Roth IRA today. Vanguard, Fidelity, Schwab. Pick one and open the account. Automate a monthly contribution. Even $100 per month is $1,200 per year in tax-advantaged space you weren't using before. Step 2, evaluate HSA eligibility. Look at your health insurance. If you have a high deductible plan, you likely qualify for an HSA. Open one immediately. Start with whatever contribution you can afford and treat it like a long-term investment account, not just a medical spending account. Step 3, track your expenses like a business owner. Even if you don't have a business yet, start tracking your expenses as if you did. Notice how much you spend on your phone, internet, your car, meals, education, equipment. You'll quickly see where business deductions could apply once you establish a legitimate business entity. Step 4, start a legitimate side business. This is the game changer. You don't need a complicated business plan. You need a legitimate business activity with profit motive. Consulting in your field of expertise, freelancing, selling products online, creating content, coaching. Pick something that aligns with your skills and start. Register your business. Get an EIN from the IRS. It's free and takes 10 minutes online. Open a separate business bank account. Track all income and expenses meticulously. Use accounting software like QuickBooks or Wave. Step 5, work with a real tax professional. Here's the thing. H&R Block and TurboTax are fine if you're a simple W-2 employee. But once you have business income, investments, or real estate, you need a real CPA or enrolled agent who understands tax strategy, not just tax preparation. A good tax professional will save you multiples of what you pay them. They'll find deductions you didn't know existed. They'll help you plan throughout the year, not just file in April. Expect to pay $500 to $2,000 for a competent professional. It's worth every penny. Now, I know some of you are thinking about real estate, so let's address this directly because this is where things can really accelerate. You don't need massive capital to start with real estate. There are strategies like house hacking, buying a duplex, living in one unit, renting out the other. Your tenant's rent covers most or all of your mortgage while you're building equity and taking depreciation deductions. Another option is the BRRRR strategy. Buy, rehab, rent, refinance, repeat. You buy a distressed property, fix it up, rent it out, refinance to pull your initial capital back out, and use that capital to buy the next property. The tax advantages compound with each property you add. Here's a specific example. You buy a $200,000 duplex with an FHA loan requiring only 3.5% down. That's $7,000. You live in one unit, rent out the other for $1,200 per month. Your total mortgage payment is $1,400. Your tenant is covering 85% of your housing cost, while you're getting tax deductions for the rental portion and building equity in an appreciating asset. After 2 years, you move out, buy another duplex with another FHA loan, and now you have 2 rental units generating income. You're building wealth and reducing taxes simultaneously. Additionally, real estate losses from depreciation can offset your W-2 income if you qualify as a real estate professional or if your income is under certain thresholds, $100,000 to $150,000 depending on your situation. This is passive income that shows as a loss on paper, reducing your overall tax burden. Let's talk about what happens when you actually implement these strategies over time, because this is where the math becomes absolutely undeniable. Let's say you're currently making $80,000 per year and paying an effective tax rate of 20%. That's $16,000 in taxes annually. Now, let's say you implement the strategies we've discussed. Max out 401k, $23,500 contribution, saves you $5,640 in taxes, 24% bracket. Max out HSA, $4,300 contribution, saves you $1,032 in taxes. Start side business with $10,000 net income but $4,000 in deductions. Saves you $960 in taxes. Total annual tax savings, $7,632. But here's where it gets really interesting. That $7,632 you didn't pay in taxes can be invested. Over 30 years at 8% average return, that annual tax savings becomes $868,000. You heard that right? The taxes you don't pay, when invested, become nearly $900,000 in wealth over 3 decades. This isn't hypothetical. This is just compound interest on money you kept instead of sending to the IRS. And we haven't even factored in the growth inside those tax-advantaged accounts. Your $23,500 in 401k contributions, invested for 30 years at 8%, becomes $2.68 million. If you do this every year, you're looking at retirement accounts worth several million dollars, most of which grew tax-deferred or tax-free. This is how wealthy people build generational wealth. They don't earn drastically more than everyone else in the beginning. They keep more of what they earn, invested in tax-advantaged ways, and let compound interest do the heavy lifting. Okay, I know there's fear around this topic, so let's address it head on. Objection 1. Isn't this tax evasion? Number. Tax evasion is illegal. That's when you deliberately lie about income or claim false deductions. Tax avoidance is legal and encouraged by the tax code. Every strategy I've described is explicitly allowed by the IRS. The tax code is written with incentives to encourage certain behaviors: retirement saving, business ownership, real estate investment. Using those incentives isn't cheating. It's playing by the rules that already exist. Objection 2. The IRS will audit me if I take too many deductions. The audit rate for individuals making under $200,000 is less than 0.5% according to recent IRS data. And even if you are audited, if your deductions are legitimate and you have documentation, you have nothing to worry about. The key word is legitimate. Don't claim deductions you're not entitled to, but absolutely claim every deduction you're entitled to. Objection 3. I don't have time to start a business. You don't need to quit your job or work 80 hours a week. A side business can be 5 to 10 hours per week. Many successful businesses started as weekend projects. The question isn't whether you have time. The question is whether you're willing to trade Netflix time for wealth building time. That's a choice only you can make. Objection 4. This sounds too complicated. It's only complicated if you try to do everything at once. Start with step 1. Max out your retirement accounts. That's simple. Then add step 2 next year. Then step 3. You don't need to implement everything simultaneously. You need to start moving in the right direction, and each step gets easier as you build momentum. Section 10. The mindset shift that changes everything. Here's what I need you to understand at a fundamental level. The tax code is not your enemy. The tax code is a set of incentives, and you can choose to respond to those incentives or ignore them. The government wants you to save for retirement. That's why they make those contributions deductible. They want you to start businesses. That's why there are hundreds of business deductions. They want you to invest in real estate. That's why depreciation and 1031 exchanges exist. Wealthy people understood this early. They stopped seeing taxes as something that happens to them and started seeing taxes as something they can legally minimize through strategic financial decisions. This is the exact same mindset shift that separates people who build wealth from people who stay stuck. It's not about how much you earn. It's about how much you keep and what you do with what you keep. When you max out your 401k, you're not depriving yourself. You're paying your future self first and getting a tax deduction for doing it. When you start a business, you're not taking on more work. You're creating tax-advantaged income streams. When you invest in real estate, you're building assets that appreciate while generating tax deductions. Additionally, there's a psychological benefit that nobody talks about. When you take control of your tax situation, you feel more in control of your entire financial life. You're not a passive victim of the tax code. You're an active participant using the rules to your advantage. That confidence spills over into other areas of your finances and your life. Look, I'm going to be honest with you. Most people watching this video won't implement any of these strategies. They'll watch, think that's interesting, and then do nothing. They'll file their taxes the exact same way next year and complain about how much they owe. But you're not most people, or you wouldn't have watched this far. Here's the reality. The tax strategies wealthy people use aren't secrets. They're published in the tax code. You can look them up. The difference is that wealthy people have advisors who proactively implement these strategies for them, while most people have tax preparers who reactively file their returns based on what already happened. You can hire those same advisors. You can learn these same strategies. You can implement them starting this year. The only question is whether you will. Seriously, the difference between your current financial trajectory and the trajectory you want isn't information. You now have the information. The difference is execution. And execution requires you to take the first step this week, not someday. So, here's your action plan. I want you to pick one strategy from this video and implement it within the next 7 days, not next month, not after you do more research. This week, if you're employed, log into your 401k and increase your contribution percentage by at least 2%. If you qualify for an HSA, open one and set up an automatic contribution. If you've been thinking about a side business, register your business entity this week and get your EIN. Pick one. Do it this week. Then 30 days from now, add another strategy. In 60 days, add a third. By the end of this year, you'll have fundamentally changed your tax situation and set yourself up to keep thousands more of your own money. The tax code gives you legal tools to reduce your tax burden. Wealthy people use these tools every single day. You can too. The information is no longer the barrier. The only barrier now is your willingness to take action. Your future self, the version of you that has an extra $500,000 or $1 million in retirement because you kept money instead of paying it in unnecessary taxes, is depending on the decision you make right now. So here's what you do. Leave a comment below telling me which strategy you're implementing first. Subscribe to this channel because we're going to keep breaking down exactly how money works for people who actually want to build wealth. Hit that thumbs up if this video changed how you think about taxes. The wealthy aren't paying less in taxes because the system is rigged against you. They're paying less because they understand the system and use it strategically. Now you understand it too. The only question is what you're going to do with that understanding. Stop overpaying. Start strategizing. Your financial freedom depends on it.